Blackstone Mortgage Trust is cutting its dividend by 24% on rising defaults, increase in struggles for borrowers to either make payments or refinance. The board of the $3.4 billion real estate investment trust, known as BXMT, authorized the repurchase, though, of $150 million of stock to lift the value of the shares. Shonali?
Meanwhile, short seller at Muddy Waters, Carson Block, made the decision to short BXMT back in December. He was on air on our program just 2 weeks ago and explained the rationale regarding the dividend.
Our thesis from when we unveiled it in December of last year is that in the second half of this year, BXMT is going to cut the dividend. A lot of these loans are in trouble. BXMT has not trued them up in terms of the risk ratings. So we believe that as more and more of these loans are allowed to pay in kind, that in the second half of this year, BXMT is going to have to cut the dividend.
Want to now take a quick check on some of Blackstone's competitors here, because, of course, there are a lot of publicly traded REITs, some of them now down pre-market. KKR Real Estate Finance Trust dropping 1.8%, the worst of the pack, really. But Arbor Realty, Apollo Commercial Real Estate also down on the day. Joining us now for more on Blackstone, we are joined by Nir Kaissar of Bloomberg Opinion. And you think about Blackstone, and the reason it becomes worrisome is because Blackstone is kind of the gem in the room. It's been considered the safer of assets. And if you extrapolate across the real estate industry and other places, you could see problems. What do those problems look like?
Good morning, Shonali. Yeah, I think we have to talk about the big question, which is when we're talking about commercial real estate, are we going back to pre-pandemic work life or are we not? And this is something that we've been struggling with for years. In my view, since the beginning, since the pandemic, has been that we are not. And the reason we are not is because it doesn't make any sense. Now that we have the technology to be able to do work anywhere, it doesn't make sense for someone who lives in a suburb to commute an hour each way to go into the office and do the exact same thing in the office, sit at their desk and respond to emails that they could do at home, or they could do in an office closer to their house, or however alternative arrangement that you can conceive. And therefore, I think because of that, we are in a process of a multi-decade sort of secular change in where we work, how we work, et cetera. And I think there's a lot of denial about that. There's a lot of denial, I think, from, excuse me for saying, sort of older generation of workers who want to see us return to pre-pandemic levels, and also from commercial real estate investors who don't want to have to make hard decisions about taking losses, about converting real estate properties, et cetera. But the more we avoid this question, the more it's going to come back to us. And this is, I think, one of many sirens that are going to come
And
our
also
way.
from Blackstone, right? I mean, wasn't there denial there? I'm getting like Democratic Party vibes. Like, he's fine, he's fine, he's fine. No, he's not going to run. Do you get that too?
Well, apparently we're going to see President Biden at 8 p.m. tonight, so that'll be very interesting. But I mean, near to that point that there needs to be this realization of what you're saying, that things aren't going back to pre-pandemic levels when it comes to office occupancy. What does BXMT, Blackstone, and all these other REITs do? Because you take a look at BXMT specifically, they say that they've cut net exposure to offices by $1.4 billion over the past 2 years. They've cut the dividend. Is it enough?
Well, they're going to do the only thing they can do, I think, which is what you're referring to, which is they're going to pivot and they're going to make some, unflattering announcements along the way until they can pivot out of the space. And ultimately, whoever's left holding the bag will hold the bag. But I think there's going to be some bad news to come. And, whether it's enough or not, one way to gauge that is obviously by their exposure. But there's another way, which you can look at the historical yield on mortgage REITs, and you could see where they are relative to their historical average and their standard deviation. So, for example, I was looking at the numbers this morning. Right now, the yields on mortgage REITs are a tad bit above their historical average, which tells you that if there was any enthusiasm in the space, it's gone out. But it's not even a standard deviation above that average, which also tells you that there's a lot of downside still. If what I'm saying is right, ultimately, that mortgage REITs, commercial properties are going to suffer in the next 5 to 10 years, let's say, you're going to see more pain in those yields. And so I wouldn't say we're anywhere near distressed levels yet.
Nir, I don't know if I'm just a moron, but what does it mean? I know that I'm a moron.
You are not a moron.
What does it mean that they're cutting the dividend, but then buying back $150 million in shares? What does that tell you about Blackstone's strategy or thinking here?
Well, the cutting that I think they're anticipating that there's going to be defaults, which is clear. I mean, that's one of the things we haven't seen yet. is the wave of defaults that are going to come, because there's some stub period. Interest rates went up, but there are current loans in process. Usually they would go to refinance them. Now when they go to refinance them, the interest rate is going to be a lot higher, and that's going to be problematic for their P&L. And so you're going to have defaults. And so I think Blackstone is trying to get ahead of it by cutting the dividend. They're trying, I think, to conserve some cash. And by buying back shares, I think they're trying to, I don't know for sure, Matt, but I think what they're trying to do is they're trying to add some control to their own portfolio, their ability to pivot the portfolio into places that they think there's going to be a higher return and a lower risk going forward. That's my read of that, but I'm not entirely sure, to be honest.
You know, you think about the bid that you've seen in the banking sector recently, the KBW Bank Index, 5 out of 7 days has been in the green. And then you see this morning Deutsche Bank moving to put aside more money for souring loans in the real estate sector. And for those who don't remember, it was Deutsche Bank, JP Morgan, some of the biggest lenders. But of course, the regional banking system now more exposed. Do you think what's happening at Blackstone signals more trouble than investors are currently baking in because they're so excited and near about those rate cuts?
For sure. I mean, I think everybody's in denial about this is my broad view. The question is, who's going to be left holding the bag? I don't think we have our arms around this yet. How much exposure do regional banks have, and what does the quality of that exposure look like? Because even in a distressed market, which we're not there yet, but even in a distressed market, there's going to be quality among and along the commercial properties and who's holding what. And, in general, the more sophisticated players tend to be savvy about holding higher quality. So knowing nothing, I would say that I would be concerned about the regional banks. But this will unfold, I think, hopefully slowly and not quickly. I mean, we don't want a crisis on our hands, but hopefully this will unfold slowly. There will be a wave of defaults. We'll be able to manage through it as an industry. And hopefully the folks who are holding the lower quality properties will be able to get some help. But, that's, I think, best case scenario in my view.